Yes. So yes, please include in the chat where you tuning in from, even if this is not your first time. And then also, if it is your first time, put it in the chat for us as well. We're going to get this podcast started. I appreciate you guys being on this evening. I'm so excited. Oakland, Tennessee, welcome, welcome. And tell us, how did you find out about it, Kira? Um, share with us, share with us. Welcome, welcome, welcome. I know several people said they were getting on, so we're going to record it and we'll be able to share it, Becca, as well.
Sounds good.
Awesome. Good, 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 good. So I am going to, while people are still popping in, I'm going to go ahead and just introduce Empowered by DS. And then we'll be able to give you lots of time.
Perfect.
And if you guys have, be
Can
thinking
you hear
about,
me okay?
I can. Yes.
Okay, perfect. Just making sure.
Okay. And if you have questions, make sure that you get those. We will definitely have question time. Take advantage of this time. Let's see. Let me stop talking because I can't. Uh-oh, that's not the right one. This up to the right place. There we go. There we go. All right, let's go ahead and get started. I am the dynamic daring, one-of-a-kind diva, Denise Silas. I'm excited to have you guys here for our Let's Talk About It Tuesday. We host these mostly every Tuesday. And it's a variety of topics that we have to help to empower women to be the best version of themselves. So I know Kiera said this is her first time on Empowered by DS experience. So I want to introduce you to who we are. So Empowered by DS is myself, Denise Silas, along with my two daughters, Alea and Amani. Our whole mission is to empower women to be the best version of themselves in their current season of their life. So we create experiences to help women to connect, to help them build confidence, help them build connections, as well as building community. So we do it with our Divas Dinner and Dialogue, which that is more of a social atmosphere, but we have conversations about things that matter to women. We do empowerment workshops as well. And then we do things all about the full woman. So it's things related to faith, family and relationships, to career and finances, to fitness and wellness, as well as fun and social self-care. So one of the things that is our signature, and I want you guys to put it on your calendar for September 23rd, is our Feel the Tilt in Your Hottest Heel for ovarian cancer awareness. This will be our 15th event that we're doing in memory of my sister. And so we'll be getting some information out regarding that. It's a game night that we'll be doing to help raise money to help to find a cure for cancer, for that type of cancer. Also, we have our website, Empowered by DS. You'll see all the things that we do. So it ranges from coaching to I do group coaching, group training, public speaking, as well as these different events that I host. So the events that I host, I can even bring it to people's place of employment, to church groups as well. So check us out on Empowered by DS to learn more about who we are and what we do offer. Our next event, also follow us on social media. So we have our next event on July 21st. It's going to be the 14th or 21st. If we get this additional speaker, we're going to change it to the 21st. But that is about recapping, because we're right at the middle of the year. So we want to recap what we've done. We want to review that, regroup to restart. So it's our mid-year check-in. So it's our vision check-in. At the beginning of the year, we always do a vision board party. At the end of the year, we do a vision to victory party. So what we're doing is in the middle of the year, checking to see if we're on track to achieve the things that we say that we want. And then to regroup to get ourselves back on track, or maybe time to look at and say, okay, those are things I said I want. However, just some things have happened and I need to shift gears. So that'll be our opportunity. So it's going to be a virtual event. So be looking out for that. that we'll be having that. And then our next Diva Dinner and Dialogue is going to be August 1st. So put those 2 dates on your calendar and we will get you more information regarding that. So, and connect with us on all social media platforms, email, website, everything is Empowered by DS. So we're excited to be able to do that as well. So I'm going to jump on over here, because I don't think I got a bio for you. Did I get a bio? Did I miss it?
I don't know, but I can introduce myself. It's kind of part of my slide too. So you can
Good.
just let me know what you want me to do or when you want me to start talking.
So so you guys, I've had the pleasure of meeting Becca. We in a networking DeSoto County business women together. I've been able to do a couple other things with her, and with the whole mission of trying to empower women, we talked and we knew that she had some information that can help women, because it's a lot of people's goal to own homes. A lot of people go to own homes, but they may not know where to start. So we thought this would be a good topic to bring to our Let's Talk About It Tuesday. So take it away.
Okay, so my name is Becca Rupe. I work with Premier Mortgage Resources, and I'm a local lender. I'm licensed in a couple of states, so I can help anyone in Mississippi, Tennessee, Arkansas, Alabama, and Illinois, and I actually just today got my license for Missouri approved, so I'm in Missouri now as well. So Denise, thanks for having me on. I'll go ahead and pull up my presentation. That way we can kind of get started and it goes over some information on me and some different things. So I will pull this up. Let's see. Me and Zoom are not great friends. So I'm going to go ahead and set this up now. Okay. Can you guys see my screen?
It's coming up. Perfect.
Okay. Awesome. So,
yay.
Okay, so tonight we're going to talk about getting mortgage ready, some of the steps and things that take place in order to, one, get you ready, and then two, get you into your home. So the first thing is the about me. So I am branch manager. I've been in mortgage for about 25 years now. I started as a basic, just entry level position and worked my way up, done a little bit of everything. Now I'm a licensed loan officer and branch manager. My license is my office is in Olive Branch, Mississippi. So I am local for a lot of people to come in if you guys need to ever come in and talk or meet or go over anything. My company is nationwide though. So no matter where you live, I do have options for you and people that can help that I trust. A little about me, I'm married, mom to 3 kids, mom to 3 dogs. I'm also a traveling softball mom. So a lot of mom there, but it keeps me pretty busy. I'm from California. I moved to Mississippi about 7 years ago, but if I'm not working, you're usually going to find me at the beach. That's my favorite place in the world. So let's see. So tonight we're going to talk about one, is it time to buy a home? 2, how to get started. I just realized my numbers are a little off on there, so don't mind that 3 to 5 jump. What mortgage is right for me? So what type of mortgage? Now you're ready to shop for your home. So what do you need to do? Planning for your future, do's and don'ts. And again, I guess I missed the screen, so we're going to skip over that as well. So let's evaluate. Is it time to buy a home? So the big thing is, what's your why? So that's going to be a big question you want to ask yourself is, why do you want to buy? Is it going to be security and stability? Long-term roots, your family needs? Is it just for a financial investment? Are you wanting to build that equity and appreciation, tax benefits? What's your goal in owning your home? Is it just the freedom and control so you can customize your house? You don't have to answer to a landlord. Peace of mind, knowing that you're going to have that fixed payment forever. It's not going to change unless you choose to change it. You would have to choose to refinance. You would have to choose to make a change on your mortgage. If not, you're always going to have that same payment. Pride of homeownership, and also just future planning. So your retirement, generational wealth, when you get to that stage of life that maybe you're on fixed income, how can mortgages, real estate, buying house, how can that help you? So let's see. So the things that you're really going to want to think about is your why, but also the things that are going to be important to you. So what do you need in your house? What are your needs versus your wants? What is the benefit of renting versus buying? One of the benefits, like I just mentioned, your payments lock, but you also have the expense of owning a home. So if your air conditioner breaks, if you have plumbing issues, those are your responsibility. You don't have that landlord to call and say, hey, my sink's clogged. Can you come fix it for me? There's a lot more responsibility in owning your home. So it's just making sure that you understand the investment and the responsibility and that you're financially in a position to take that on. Let's see. So the biggest things that when I'm talking to people that we run into that hold them back is the um, lack of down payment or closing costs. So one, it's going to be your funds to buy a home. Two is the income to maybe afford what you want. Real estate prices are on the rise. I mean, it's just they're getting more expensive. So it's finding ways to afford the payment and making sure that you're buying within budget. We don't want you to be house poor. We don't want the making that mortgage payment stressful for you every month. Um, lack of affordability. So finding maybe a house that you like in your price point. And then it's also lack of education and that plan of owning a home and being in the correct mindset when you're home shopping, what to look for, needs, wants, what things mean when you're out looking at the properties. So this one was new when I was kind of researching for this presentation. 72% of recent home buyers regret their purchase. And at first I said, why would I talk about that? But it's actually really important because the reason why it's lack of education and knowledge. So they got into a situation where they didn't know what they were buying. They didn't understand their loan. They didn't understand the budget. And now they're in a house and they are house poor. They're overstretched. That reality of writing that check every month to a mortgage payment, it sets in once you're making it a few months in a row. So it's just having the correct education and financial knowledge to really make sure that you're making a decision that's good for you and your family. I tell people all the time when I'm pre-approving them, I know what's on your credit report. I know what's on your taxes. I know what's on your pay stubs, but I don't know what's in your house. So like, I wouldn't know what you pay in childcare or if help your parents pay for bills or what children you're taking care of in college, or I don't know those things. So it's really to have that budget in place and just be aware of what you can truly afford is really, really important. So now let's get started. Okay, so the first thing is just knowing where you're at as far as your financial picture. So know your credit score, making sure that you have an idea where you're at as far as good credit, bad credit, what's on there. Knowing your budget. So sitting down and really writing a budget. What's your expenses? What can you afford? I get a lot of calls, and that's one thing that I always look at is we're going to look at your pre-approval from a few different directions. So one, what can I qualify you for? Two, how much money do you have and what programs can I qualify you for to help with that money? But three, it's your budget. Those are usually not all the same answers. So, if you say, if I say, hey, what are you paying in rent right now? And it's, nothing, or a couple $100, I stay with my parents, and then it's, well, what can you afford for a mortgage payment? $1,500 a month. Well, then we need to make sure you're at $1,500 a month, and we need to make sure that you're able to save that $1,500 a month, that you can keep that $1,500 in a month to make that payment. The other thing is finding a good realtor. You want a team that you can trust. So, me or another lender, but then also the realtor, your home inspector, those are all people you want to trust, you want to have good recommendations for, and just so you're going to have a good experience. Having people on your side that's going to advocate for you will really make or break your experience. You don't want to feel in the dark and you don't want to not understand what's going on. The other thing is gathering your documents. So start looking for paperwork. That is the biggest holdup in me getting letters out for people. So, pay stubs, W-2s, tax returns, start getting those documents together. If you have student loans, talk to a lender about maybe if you need to make some phone calls on those. And we'll get to student loans in a little bit more detail. And then from there, it's getting your pre-approval. So let's see. So the next thing is your mortgage FICO score. So a lot of people will call me and say, hey, I know what my credit score is. I checked it on Credit Karma. It says 650. Credit Karma is not a mortgage FICO score. It's not going to be the same when I check it. So when you're looking at Credit Karma, CreditWise, Experian, all the companies for even the FICO 8s, those are not a mortgage credit score. We use a FICO 3. The only way you're going to get a mortgage credit report or your mortgage score, is by talking to a lender. You're going to want to talk to a lender and have them pull your report, or you have to pay for it. So for like on myfico.com, they give a account that you can pay for your mortgage credit report. That's going to be close to what I pull, but it is, a cost that you'd incur upfront. So I just like people to keep that in mind, that I may not tell you your credit score is the same as what you see online. So let's see. When you get started, there's a couple steps that you're going to go through. So first is when you initially submit your application, you go online, you submit your application, and you put in what you make, how much money you have in the bank, and it comes back and it says, congratulations, you're approved. That's what we call a pre-qualification. And that's what we do not like you to home shop with. And the reason why is that's going to be based on what you put on the application. As a lender, as a mortgage company, we look at documents like our underwriters are going to, like our investors are going to. So how we calculate your income, how we look at your debts, how we do all those things, that's going to be really specific. And so when you get a pre-approval letter, that's going to be taking those things into consideration. So it means that we've looked at your documents. It means that we know we can get you approved. And so when you're out looking for a home, if you have a letter that's got some weight to it, when a realtor looks at it, they're going to look at it and say, oh, they're pre-approved. They're not pre-qualified. Pre-approved means we've got some faith in that letter that when they go into contract, they're going to close on this transaction. They're going to be able to close and get the keys. So you really want to take the time to send your documents in and work with a lender to make sure that you get pre-approved. So I've kind of gone through a few slides here. So I cannot see the chat from where I'm at. Does anyone have any questions or anything they want me to address before we go in a little bit farther into this?
No questions have been put in the chat. Can you hear me?
Okay. Yeah.
But what I do want to say though, one point I think you made really, you said earlier, when you think about when people say their budget, and I remember working with someone and the amount of money she was spending in her just personal care, hair care, getting her hair done, getting her nails done, getting her feet done. Although, when you're talking to somebody, you're not asking that, right? That's not on the application per se. But she was spending so much that it made a difference in her ability from her income to what she would really be able to pay in her mortgage. So I think having that budget, I think is very important for people to realize, like, what is your income, disposable income at the end of the day? Like, what is your disposable income? What are you really working with? And I remember back in the day, people always saying, I pre-qualified for this amount. And then, when you look at the mortgage for that, they couldn't afford that mortgage because of the other factors were considered. So I thought that was just important to emphasize.
It's so true. And I have resources even for, classes that'll teach people how to budget. In school today, a lot of that's not taught. When I was in high school, we took economics class. They went over the basics of just budgeting your household, how to plan for things, childcare and groceries and rent and utilities and, how to put that plan in place. And that's kind of skipped in school right now. So it's a good thing to really think about what you can afford, what you can set aside, and it's a conversation I have, especially with a lot of maybe, first time home buyers. They call and say, hey, I can afford a mortgage payment of $2,000 a month, but they haven't been saving $2,000 a month and they're not paying rent right now. They're living with their parents. So, that disposable income, like you were talking, where is that going? What do you need to cut back on to be able to afford that $2,000 a month house that you want? What can be adjusted, whether it's getting your nails done or going out to eat or working the overtime that you've been turning down, where are you going to get that money to really make that payment? Because it's not in your bank account. I can't see it. It means it's going somewhere. So tell me
Right.
where it's going, tell me where you're saving it, or stop spending it, if we want to get you in a house.
Right.
So it's kind of, those are the conversations we kind of have. Um, and this is why. So not only it's to be able to make the payment, but it's also your debt to income, which is the next kind of screen. So when we talk about debt to income, it's how we look about what you can qualify for. So what we take into consideration are your reoccurring bills, not utilities. I don't care about medical bills. What I care about is car payments, credit cards, loans, student loans, and then your mortgage payment. So the underwriter for all of your debt, most loan programs want you to be at a less than 50%. So that means if your income, if you make $3,000 a month, that means all of your debt cannot be over $1,500. So if you've got a car payment at $600, that means I have $900 for a mortgage payment, not counting if you have credit cards or student loans or anything else. So when we talk about what you can what you can qualify for, your credit matters, your income matters, and your debts do, because it's a big puzzle. We're going to take it, we're going to put it all together, and then they're going to say, okay, well, math, we look at it like a math equation. This is what you can qualify for. So that's why we'll call and say, hey, do you make your car payment or does somebody else? Who pays your credit cards? Or, do you have money in savings that maybe you can pay this account off? And that's why, as we're looking at that debt to income, the debt to income ratio with the underwriters of how much we're allowed to qualify you for. So all of these questions, people sometimes will ask me, like, why do you care? Like, why are you worried about this payment, or why are you worried about this thing on my bank account? And this is why, the underwriters are looking at it to make sure that we're within our approvable limits for your debt to income. So when we ask questions, just keep that in mind and just let us know if there's things that, if I say, hey, do you have student loans? And I don't see them on the credit report, but you do, make sure you tell me. We're going to see them eventually. So just kind of walk through it and make sure you really let your loan officer know what you have going on financially. Um, and this is where we talk a little bit more about debts. So the big one we run into is your student loans. I get that call a lot. Can I buy a house if I have student loans? Yes, absolutely you can. But we have to know what's going on with them. If your student loans are in deferment or they're in forbearance, one, we may not be able to see them on your credit report. So you're going to want to tell us about them, because I've had a personal experience with loans where they come up later in the transaction and I was not made aware of them, and they can mess things up when you're trying to buy a house. But it's also because we want to look at it and see what your status is to know what options you have. If you're in forbearance, you're in deferment, we're going to take whatever you owe and we're going to do an estimated payment. That can be 0.5% to 1% of the balance. So that can get pretty expensive pretty fast when we're looking at what you qualify for. But if you're in a payment arrangement, if you're in an income-based payment plan, or you pay $20 a month, if you're in any type of payment plan, that's going to change how we look at it. It's a big deal. And the reason I say it is, so I had a teacher that was buying a house and she had went to another lender and her deal fell apart. They couldn't do it. And partially it was because of her student loans. So I had her get on the phone with the servicer and said, hey, I'm buying a house. I need the cheapest payment I can possibly get. It's messing up my loan. What can I do? She owed $122,000 in student loans. She was a teacher. I mean, and she was out of school, but she hadn't started making payments on it. They set her up on a payment for $12 a month. If you can buy a house, you can afford $12 a month. So she started making her payments, and I could use that $12. So $12 on $122,000 in student loans, and she got to buy her house. So, she got in a house that she loved. And it was just because she worked with me, she listened, she made the phone calls, she did her homework, and those student loans that made one deal fall apart, we got it fixed, and she's a homeowner today. Absolutely loves her house. So the other one is credit cards and installment debts. Just make sure that you're making your payments. I cannot stress that enough. Even if it's the minimum payment, do not miss payments. Please make your payments. When we go through them, I'm not as worried about charge-offs. Charge-offs do not get counted in your debt to income. I'm not as worried about medical bills. but they do affect your credit score. So if credit score comes in the picture, sometimes I'll say, hey, can maybe you pay off this medical bill? Sometimes, and a lot of times it's maybe to get your score up to qualify for different programs, things like that. The other one I run into a lot is child support. So if you owe child support, please pay it. If you're not paying it, you have to get on a payment arrangement for the arrearage. If you are not paying child support, you cannot get a mortgage. I just had to decline someone for that very reason last week. You have to be current on child support or in a payment plan to get current. Let's see. So the next one is, so when you're thinking about that mortgage payment, we're talking about budget, is what's all included in your payment. So what do you have to budget for? So it's your principal and interest. It is a loan payment. It's your property taxes. Everyone has to pay their property taxes. Their homeowners insurance. You want your house protected if you have a fire or a flood or something happens. And it's also typically mortgage insurance. Now, mortgage insurance is not for you. It's for the investor. It's protection if you default on your loan. But unless you have a significant amount of money to put down, 20% or more, you're going to pay mortgage insurance. So all of that's included. So when you say, hey, I can afford $2,000 a month, $2,000 a month to me is going to be your loan payment, your taxes, your insurance. It's going to include everything. So we take care of that. It does not include if you find a house with a homeowners association, if it, your utilities, anything like that, that's your responsibility. But if it has to do with the insurance, the taxes, or the loan, we will include that within your monthly payment. Okay, so there is a lot of information online about mortgages, especially on social media, that goes over a lot of different loan types. Depending on where you live, what you qualify for, your credit score, where you want to buy, all those things can affect programs that are available, but most of them are going to fall into these kind of categories. So you have a conventional mortgage. Conventional is a 30-year fixed mortgage. It's got a decent interest rate. If you have 20% down, you don't have to pay mortgage insurance. It allows you to do second homes. You can buy investment properties on conventional mortgage. It's a great option. Jumbo mortgage, we don't have a lot of that in our area. Prices just aren't quite high enough for it, but that's when you're buying the really expensive houses. FHA is what a lot of people buy with. It's called, a lot of people refer to it as like a first-time home buyer loan. You do not have to be a first-time home buyer for FHA, but it gives a lot more flexibility as far as your credit, your debt to income. It lets you borrow more money, and it also partners with a lot of the local down payment assistance programs. So it's typically going to be 3.5% down of your purchase price. And unless we can get you in a program to help cover that cost, which I do have options for that. There's also USDA. A lot of people know that one as the rural housing loan. You have to buy in county limits or rural areas, but it's 100% financing. So if you're not wanting to live in town, it's a great option. USDA loans are great loans, but they do have different limits for your debt to income, credit score, and limits where you can buy. So there's a little bit more restrictions, but if you can make it work, it's a great option. And then VA loans. If you're a veteran, veterans qualify for 100% financing as well. So all of those are where I start. So I'll say, okay, you're going to buy in Memphis and you have, a 650 credit score and you have $5,000 to work with. And I start building this picture and I look at these options to see which ones are going to be the best option for both your cash to close, your payment, and how much you can qualify for. So the biggest question I get is how much money do I need? People call and they say, hey, what do I need saved? Do I need $5,000? Do I need $6,000? What is it? And a lot of people still think that you need 20% to buy a home. You don't. There's a lot of 100% financing options. There's local grants, loans, assistance programs that help bridge that to where you really need little out of pocket. So it's not a set amount, but when you look at what the loans require, it's going to always be a percentage. So FHA requires a 3.5% down payment. So if you want to buy a $200,000 house, that is a $7,000 down payment plus your closing costs, unless there's some sort of financing that can kind of bridge that gap for you, that can help you pay that money. So that's where the down payment assistance come in. Those are going to vary where you live. So like Mississippi has Mississippi Home Court. Then I think the next slide is the one that kind of goes over these. Yeah. So Mississippi has the Mississippi Home Court program. You do need a 640 credit score. They do have income limits on their programs, but they have anything from $6,000 to $25,000 to help you buy a house. It's great programs, great options. Tennessee has more organizations that can kind of help with that. So we've got THCA, City of Memphis, Tennessee Housing Fund, and Shelby County locally. I use these all the time. They are great programs, about 600 credit score or higher, and they offer anywhere from $6,000 to $35,000 to purchase a home. Some of the programs are forgivable. So if you live in the home, you do not have to for an extended period of time, you don't have to repay it. Some of them have monthly payments, some of them don't. All of them have different guidelines. So again, it's just going to kind of come down to what we can gonna get you qualified for, but we're always going to look at the most money for the cheapest payment and the best repayment terms. So we'll talk to you about those options. And then if you don't qualify for those, other states have local programs. So like Arkansas has, I'm drawing a blank on the Arkansas's program's name, but like Alabama has Step It Up. Every state has these local programs, and then we have nationwide programs as well. So like my company has a Home Start program. It comes out to being 100% financing using an FHA loan, 600 FICO score. There's no income limits, and you don't have to be a first-time home buyer. I use that program a lot. It's a great option for people. Chenoa, we have Arrive. We have a few other ones. So there's options. There really are options out there. It's just talking to your loan officer, getting your application in and seeing what you need to do to qualify. And sometimes it takes work. I always say, sometimes I'll give you homework because maybe we need to get your score up a little bit, your credit score up a little bit, or maybe pay off some debt to get you within the guidelines for the program. But if we could use your savings to pay off debt so you don't have that monthly payment after closing, and then I can get you the money to make it up to get in a house, it's a win-win. I mean, it really would work out. It gets you to your goals and keeps you in budget. So when I ask how much money do you have available, it's because we're going to talk about down payment and closing costs. So closing costs are what you pay to get your loan done. As a lender, we have expenses in doing your loan. So it's the cost of doing that, as well as the attorney, the appraisers, the home inspectors, getting the account set up for your taxes and insurance. Those are all things that have to get addressed. So when we talk about your cash to close, we talk about what you need. It's always going to be, in my mind, I'm always thinking about this too. It's not just your down payment, it's your closing costs. Now, we can ask for the sellers to contribute a credit to help pay for that. And that's why you'll hear online, they say, don't wait, don't wait right now. It's a buyer's market where you can ask for closing costs, you can ask for help, you're getting it approved. And that's because right now we are getting it to where the sellers need to sell their house. They're not getting as many offers. So they're willing to help. They're willing to give these credits to help you. When the market turns, let's say interest rates drop. A lot of people are saying we want to wait for rates to drop. But that market turns, and then you're not going to have that willingness from the sellers to help you. If they have 5 offers on their house and other people have money, or it's a cash offer and you need help, you need them to pay your closing costs. So they're going to make less money. At the end of the day, a lot of times they're going to take the one that they're going to make more money. Your offer is not going to look as appealing if you're asking for a lot of money and credits and different things. So, I just saw there was some chat questions in the chat. We'll address those here after this slide. So those are all things that we're going to talk about, we look at is, okay, if you can get this money, if you can get this money and then I can get assistance program for this money, but we still have this that needs addressed, maybe we can ask the seller to help for that. Or maybe we can adjust some numbers on the loan to make sure that it gets covered. The last thing I want to do is get to closing and me say, hey, where's your money to close? And you have no idea you're supposed to come up with that money. I want to be, we want to be transparent and we want you prepared for what you're about to buy. So let's see, there was a couple questions that got put up. Um, let's see. So if you just bought a car, no, that's absolutely okay. If you just bought a car, you can buy a home, but we just have to make sure you qualify with the payment. So when we look at that debt to income, we're going to take that car note into consideration. And as long as the numbers all work for you to qualify, you're absolutely fine. And let's see. Yes, the home warranties are great options. Your realtor will go in a little bit deeper on a home warranty. The cost for that can be negotiated with your contract and it's included with your closing cost. But that home warranty is going to help you with those surprises that I mentioned in the beginning. Your AC breaks or you have a plumbing issue, your water heater goes out. That home warranty is going to help you with that cost. So instead of having full repair costs, you'll just have maybe like the copay, kind of like with your insurance, like medical insurance. It's like house insurance. It's just that copay for them to go out and help you get that stuff fixed. Um, let's see. And then the other question here is, how much does credit score help with the interest rate? It helps. And depending on the program, it's not again, not a super direct answer, but the higher your credit score is, the lower your interest rate and or fees will be. So when you look at your interest rate, as a lender, we have options. So I'm going to just use easy math here to kind of keep track of it. So if I say, hey, you can do 6.5%, but it's going to cost you $1,000. Or you could do 6.25%, but it's going to cost you $5,000. Those are conversations that we have. If your credit score is low and then we're able to increase it, maybe that cost goes to, instead of 1,000, 0. Or 5,000, maybe it goes to 2,000. So it's going to save you money. And then if you have that money, if you have the money to invest in your interest rate, you still have that option. So you could maybe buy it down to 6%, and then that'll give you a cheaper payment. So it does make a difference. I can work with lower credit scores. There's options. I actually pre-approved someone yesterday with a 559 on USDA financing. USDA technically doesn't have it doesn't have a minimum credit score. It's one of the few programs, but they have some additional qualifications. He met them. So we were able to do a 559 credit score, but his interest rate 7 1/8. I mean, it's a higher interest rate. So, but he has he has a low credit score. If he can work on that and get it increased, then I would be able to update his credit and give him the benefit of the higher interest rate, as long as we could prove that adjustment before closing. So that's one thing we talk about is, hey, pay down this card or, do this. And if it updates in time, then we can give you the benefit of that. And that's what we're talking about with the interest rate. This is that discount points. So the discount point is the exact cost for your interest rate. So when you look at your fee breakdown, if you're looking between lenders, there's only a few fees that you're going to want to compare, and it's just your lender fees. And the discount points is the big one you're going to want to look at, because you'll have people call you and say, hey, I can get you a better interest rate. Maybe I told you 6.5, and they call you and say, hey, I can get you a better rate. I can get you 6%, but they don't tell you the cost behind that rate. So they could be charging you thousands and thousands of dollars, and you have no idea, because they're not giving you the breakdown of their fees. They're showing it in a different, maybe format, different things. The loan origination and the discount points are the two that you really want to pay attention to. But the discount points gets missed. Everyone focuses on loan origination fees. The discount point is the cost for your interest rate. It's very, very important to pay attention to. So now we kind of talked about the home warranty, but The home warranty is going to protect you for things that go wrong after you've bought your home. But how do you know that you're looking at houses that are safe, that are up to code, up to standards, that um, you're not going to have 100% guarantee, but you have good faith that you have a house with good bones, that you're not going to have problems with. And that's your inspections. So there's two separate inspections. One is your appraisal. Now, your appraisal, I require as a lender. You got to get it done. That's going to tell us how much your home is worth. It's going to tell us that you're buying a home at market value, that you're getting a good deal on your house, that you're not overpaying a lot of money. So we always require that. And it also checks for health and safety. So it's going to make sure that our health and safety requirements are always up to code. So broken windows, railings on stairs, that your light switches work, plumbing leaks, that your hot water heater's turned on, your paint is not chipping off your house. It looks for things because remember, this lender is giving out hundreds of thousands of dollars for these houses, and they want to make sure that it's a good investment. They want to make sure that house is going to be around and worth the money if something happens down the road. They want to make sure that you have a house that you're going to want to make that payment on. So that appraisal is to make sure that that's in place. The second one is going to be your home inspection. I don't require it. I highly, highly recommend it. That is when a home inspector goes out and they're going to look at everything. They are going to nitpick your house and you're going to get this long report and it's going to kind of make you panic a little bit about buying. 99% of the stuff in there is not going to really matter. They're going to point out if there's a crack in your light switch plate. 99-cent fix, easy fix, but they're still going to put it on that report. But they're also going to point out the bigger things that your realtor is going to be able to go through with you and say, hey, look, this is a problem. The lender may not call this out. It may not be required to get fixed, but you need to make sure that you're aware it's there, that you have the money set aside to take care of it if it breaks, or negotiate for the seller to make those repairs. It could be your roof, it could be your AC, it could be cracks in your stucco. There's a lot of stuff that'll come up on that home inspection, and a good realtor will go through it line by line, talk to you about it, what's really a big deal, what can maybe be overlooked. And that's when you can negotiate for sellers to make repairs on there before you close. So those are things you're always going to want to talk to. The realtor's a little bit more involved on that side. So then we're going to talk the closing process. And I bring that up just because there's a lot of terminology in it when you get to closing. They're going to call it escrow, closing, attorney, all these things. And there's going to be fees associated with them. And they're the ones that are basically making sure that you're buying a house that when you sign my papers, that house belongs to you. There's no easements. There's no one else claiming that they own the house. All of the prior mortgages and deeds are paid off. There's no mechanic liens. Utilities the easements are done correct. They just make sure that all your property legally is all yours and no one can question that they own it. And if they do, they offer insurance to protect you, to make sure that you have a solid investment. We have a lot of really good attorneys in our area. So they're the ones that are going to walk you through this process here. So I pointed out a few of the bigger steps, but this is a great kind of timeline that shows what you do when you buy a house. So we're going to start with, let's say, meet with lender, meeting me today. So you're going to meet with your lender. You're going to do your loan application. We're going to talk about loan options, issue your pre-approval letter, go through underwriting, and you're going to be home shopping. This section, number 4, 5, and 6, all kind of gets done at the same time. So my company, how we do it is we actually will issue your pre-approval letter based on what I have as far as your documents, my experience, my system, guidelines. And then while you're looking for a home, we start putting you through underwriting, just so that way we've got time to work on any questions, or if there's any maybe documents that are harder to get, you've got time to take care of it. And then, so once you're home shopping, you find a house, you put in an offer, your offer's accepted. That's great news. It means you're in contract. So once I pre-approved you, you work with your agent to find a house. They really kind of take the reins at that point. They're going to work with you. And then once they call me and say, hey, Becca, we got an offer accepted, that's when I'm going to step back in. And I'm going to say, okay, well, this is your next step. We're going to go over your loan disclosures. That's when we lock in your interest rate. We'll order your appraisal. And so that stuff happens during steps 8 and 9. and we get you submitted into underwriting, they're going to review and they always are going to come back with more questions. So even if I say, hey, your underwriting approved, they're going to ask more stuff. And it's because your documents expire. So if we had, let's say it was 30 days till you found a house, we're going to need new pay stubs, updated bank statements. It doesn't mean there's a problem. It's very normal. It just means that we've got to update everything. Then we're going to issue once you're approved, we issue your closing disclosure. That is a big thing. We refer to it as a CD. Your CD is very, very important. Make sure you understand it when you get it. That is your legal form that says what your interest rate are, what your fees are, and what you're responsible for at closing. There's also a 3-day waiting period. So if you sign that form and think you're going to close the next morning, it is not going to happen. It is a federal law. You have to wait 3 days. So we get that out to you as soon as possible. We don't want any delays. Then you go to the closing table. You guys are going to sign your papers. You're going to send any money that's due, and then you're closed. That's when you get your keys. Everything's great. The attorney works with getting it recorded with the county. That can take a couple weeks, but they'll make sure that's done. So the process, it sounds like a lot of information. It's definitely can be a little bit of work, but I promise we do make it as easy as possible. Oops, sorry, I went one too many there. So that is a lot of my presentation. I was just, oops. Was there any more questions or anything before I got into kind of the planning stage? You lock. So interest rates change every day. Actually, throughout the day, they can change. So I wake up in the morning and I have a nice app that says, interest rates opened up, and we call it green on the screen. Green is good, red is bad. So we always want to see green on the screen. That means they're getting better for the day. There's not a magic 8-ball. So I'm never able to say like, hey, you need to lock in your rate today because tomorrow it's going to get worse. But there are trends in the market that we watch. Typically Fridays, everyone says don't lock on Fridays, usually a bit higher rates or maybe right around a holiday. There's different budgets that are released. So when they go in for their budget meetings, they talk about like unemployment rates, debt spending, job reports. Those affect interest rates. The interest rate is how the government recoups a lot of money. It's our budgets based on that. So the market, all of the different industries, the tariffs, inflation, job reports, they all affect what we pay for our interest rate. And it honestly moves into every industry out there. The interest rates affect everything. So we watch them every day. I don't have a magic 8-ball, but it will drastically vary between loan programs, down payment assistance programs, your credit score, even where you're buying. There are programs that are census tract based. So if you're in an approved census tract, it maybe qualify for a cheaper interest rate, things like that. Today, I will say right now, Mississippi Home Corp is running their lowest rate right now, I think is 5.79. It's a great rate right now. They're the only ones that I know that are offering it that cheap, up to almost 7%. Without Mississippi Home Corp, I'm quoting 6.5 to 7.5% on interest rates right now. So they're just, it really varies. And if you called me today, I would not tell you the same interest rate tomorrow, unfortunately. I wish I could. I wish it would always just kind of be a straight answer for everybody. So oops, I lost my screen. It's behind it. Okay, so the next thing is planning for your future. So we've kind of gone over this. Start the conversation. Make sure you call our thing, apply as soon as possible. So if you have a goal to buy in 6 months to a year, you're going to want to talk to someone now. That's so we can kind of look at it the way a mortgage company is going to look at it and tell you what you need to do to get ready. 2, save as much money as you can. There's programs that help, but you always do need to have some money. That gets missed by a lot of people because they don't think they need any, and it They still need money for their earnest money deposit, and they need money for home inspections, appraisals. So you do need a little bit of cash in the bank. The other thing is work on your credit. Even if you can qualify, we can still get you to a credit score that can help your loan, or maybe get you into a program that can get you more assistance, things like that. And the other thing is be realistic on what you can afford. So really be, honest. Some things that we look at or talk about is, it might not be your dream home today, but if it has good bones, it could be a great rental in the future. So it might not be may not be your first home, isn't your forever home, but it can be something to build off of. Um, so savings plan. That's the biggest one I get is how can I save the money? Pay your mortgage to yourself. If you can afford the mortgage payment, put it in savings any way you can. If you're paying $1,000 and you say you can pay $1,200 for a mortgage, put that $200 in the bank every month. That adds up quickly. Let's see. And do's and don'ts. This is a big one. This will cause problems on your loan. So notify your loan officer of any employment changes in good and bad. So don't quit your job. If you get laid off, if you get a raise, a promotion, transferred, anything, let us know. That can change your loan good and bad. Keep your financial documents. So get your pay stubs, don't throw them away, save all of your paperwork. Sometimes it makes no sense, but sometimes we ask you for some odd stuff. And so just hang on to it once you know you want to buy a house. Keep your money in the bank. You cannot use cash to buy a house. So if your money is in your mattress, we need to get it in a savings account that's designated for buying a home. So keep that in mind. Once you get it in the bank, it has to be seasoned, depending on the loan program, 60 to 90 days. So you do want to get that savings account started. And then we will run a funding report. I'm sorry, not a funding report, a credit report before we fund your loan. So once you apply, don't think you can open up new debts and we're not going to see it because we will. So you can't go buy a car, no new credit cards, nothing until you're in the house and we say you're funded and you have your keys. Life happens. I more than understand that. But with life happening, your car breaks down, you need new tires, things like that. Let us know, because what I don't want to do is not know and then have to tell you you no longer can buy the house that you're in contract on. So that, just make sure that you keep that in mind. Let's see. So of course, the next thing is going to be if you guys are interested in buying a home, you have questions, you didn't want to maybe even questions that you just didn't even want to bring up on the call today, you can always schedule an appointment with me. We can do a one-on-one consultation. You can start at my website, www.homeloansbybecca.com. That'll let you submit your application. It has all my contact info. And you can also just always give me a call, and we can schedule a call if that's easier for you. Let's see. There was another question. What is best? I think it's variable rate or fixed. Depends on how long you're going to keep the house, is my honest answer, and how well you understand your loan program. So if you do a variable rate, it can adjust. And sometimes it's not a big adjustment. Sometimes it's drastic. And so that payment can change when your rate changes. So if you have their arms, if you have a variable rate, it might only be fixed for 3 years or 5 years. Depending on how long it's fixed, after that, it adjusts. So depending on what rates do with the market, it can go up or down, and your payment is going to adjust accordingly. So just make sure if you do a variable, you understand it and you know what you're getting into long term. They're great options, especially maybe if you know you're going to only be in a house for a year or two. A lot of investors will use them because it keeps their cash flow up so that they use it to pay their mortgage faster or other investments. So a fixed rate is going to give you that long-term security though. So it's going to give you that same payment for 30 years. Right now, rates are higher. I know it. Every day I'm waiting for them to come down. Both of them you can refinance. So if the big thing I tell everyone right now is the interest rate's one piece, it's just one piece of all of the stuff that we talked about and all the things that we look at. like they said, rents 100% interest. You don't get any of your money back. You're not building equity. You're not getting the credit for the appreciation. I mean, that interest rate really doesn't matter if you're paying rent because at the end of the day, all it matters is that you can pay your bill. So if you can buy a house, you can stay in budget. It's going to start building that equity. It's going to start getting you your appreciation. Then don't worry about the interest rate. Let's get you in your house and let's get you that next step. We can always keep you in mind for refinancing. You can refinance, lower the interest rate, which would lower your payment. We always look at it and make sure it's going to be a benefit to you. But your interest rate's not forever. And if your payment will not, it's how to explain it. Like your payment's always going to be the same unless you refinance, which would be your choice. So if we can get you a lower payment, lower interest rate, we will. But if you can get in a house today, then that would be our goal. So any other questions?
Becca, if there were
Yeah.
somebody who said, because you hear about all these people that talk about they can repair your credit. What tips or do you have any resources if someone is saying that they need to, because that seems to be a common thing that comes up, credit repair.
Mm-hmm. Yeah. So I do recommend credit repair when it's needed. So I'll automatically look for what I call easy fixes. If I can say, hey, pay on this credit card or settle this debt, we can get you in a house. I'm going to have you do that because then you're not going to have the cost of credit repair. If it's more than that, absolutely clean up your credit. I have a few people locally that I work with. Memphis also has the and I'm
Hope.
drawing a blank. It's Lester at Hope Credit. They have a program. It's free. It's great. I actually have some clients that have had really, really good results. You just call them and say, hey, Becca referred you over. I want to do your credit repair program. There's no cost. And when they're done, they basically I can let them, once you tell me, hey, I signed up, I can say, hey, I need them at a 640 for this program or whatever it is. They can let you know, hey, you're at a 640. It's time to call Becca again. And we communicate so we can get you in the program. So that's why we always say apply sooner than later. I hate it when people call me and say, hey, my lease is up. I have to move. I have 30 days and then I can't
Mm.
qualify them because then they have to re-sign that lease. They miss out on a year of owning a home, and it's something that we could have done if they had applied when we originally started the conversation. So just sooner than later. Once I have your application, I automatically will send you information on credit repair and secure credit cards and all of that stuff if that is an issue.
Jasmine has a question. What is your take on the Rome website for buying a home if you've heard of it?
I've not heard of it, so I don't know. I've not heard of the Rome website. I'm interested now to look it up.
And then first time home buyers. I know that's always a big thing. What information do you have about that? Where do they learn more about it? Who qualifies for first time home buyer?
So there's not a first time home buyer program. And a lot of people will call and say, hey, I want the first time home buyer loan. It's not one loan. So everything we're talking about today is going to be applicable for first time home buyers. So it's the grants, the down payment assistance, some of the 100% financing. Those are first time home buyer programs. Some of them require you to be a first time home buyer, some do not. The other thing that a lot of people don't realize is if you've owned a home in the past, your first time homebuyer status resets after 3 years. So if you've not been on a deed, you've not owned a home for 3 years, that you're now a first time homebuyer again. The other one is if depending on your divorce, let's say you're a widow or you've gone through a divorce, things like that, there are certain exceptions to the first time homebuyer rule for your housing status. So we can look at your divorce papers and sometimes they will still allow you to qualify for the first time homebuyer programs.
Any other questions? This is good information. Good information.
It's a lot. It's a lot of information to get started. I mean, I've done this for a long time, so I kind of can just let it, I can talk about it forever, but it's a lot to absorb. So, I'm happy. And some of the questions are kind of personal. I do understand that. I find out a lot about my clients. So if you have that situation you're just not comfortable speaking up about, that's what we can schedule a one-on-one. We can go over it. I can help where I can or point you in the right direction.
And you did say that data is not that you need to be ready to buy right now. You need to do it so that get yourself in position in how many months? 6 months, a year. So what if somebody said, well, I know I can't really do it now, but is a year too far out or what?
No. So if I review, because a lot of times people don't know if they qualify or not. So if you call in and I say, hey, you qualify now, great. That's up to you if you want to buy now or you want to wait. If not, at least I can tell you what you need to work on. Whether it's your student loans or paying off debt or credit repair or saving money, whatever it is. At least you know what steps you have to take. I do not recommend taking it into your own hands without having some personal advice. And the reason why is credit repair is expensive. Paying off debt's expensive, buying a house can be expensive, all of these things come into play. What I don't want you to do is assume that you can't qualify, take all your savings to pay off all of your debt only to find out that your debt wasn't the problem. I could have got you into a house, but now I need that money in the bank. So having that conversation up front lets you put your resources where it's going to work for you. Whether it's paying stuff off or saving up money or asking your parents for a gift or taking a withdrawal from your 401k or, there's all these things that people don't think about until they have a conversation with a lender. So it's just putting that plan in place and kind of just throwing it all out there and say, hey, this is what I got going on. And then we talk about what to do to get you in a house. We put a plan together and we timeline it from there.
Repeat the states that you're licensed in.
Mississippi, Arkansas, Alabama, Tennessee, Illinois, Missouri, and by the end of the week, I should be in Virginia as well. My company is everywhere but Rhode Island. And so no matter where you buy, if you call me and you say, hey, I want to qualify, just let me know. You find out you're getting transferred to Texas, I still have people that can help you. So I would just, work with you and someone on my team that's licensed in that state. So pretty much anywhere.
Got it. Pam, you're covered.
Yeah. 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 And then let's see. And Rome. And then what's better on a HELOC or home equity? I think that's probably line of credit. So the home equity loan versus the home equity line of credit, the loan is going to give you that fixed payment. So if you take out a $50,000 line of credit, you're going to have a principal and interest payment on a $50,000 line of credit. Or I'm sorry, a $50,000 loan. If you do a line of credit, it's almost like a secure credit card with your house. So if you take out a $50,000 credit card on your house or a line of credit on your house, but you only borrow or you need 20 of it, your payment is going to be based on 20,000. So it gives you that ability to use it and pay it off, use it and pay it off. It's a line of credit. The loan is one time, you pay it off. When it's paid off, it's typically closed and you can apply for another one. So it depends on your needs and your budget. I do a lot of line of credits for like debt consolidation. So the line of credit, okay, maybe it's 9 or 10% on the interest rate, but your credit cards are 33. Let's get you on an equity line where it's a set interest, lower interest rate, set monthly payment. Let's put a goal and you can get your debt paid off quicker and easier. The line of credit, I do a lot for maybe like investors or, people like me that don't have like commission only income. They want that extra savings emergency fund if something happened, or we open them strictly for emergencies. People use them just to have them if they need them. Let's see. Am I local? Yeah, my office is in Olive Branch. So yes, I'm in DeSoto County. I'm all over the place around here, but if you're familiar with Olive Branch, it's right across the street from the co-op off Pigeon Roost. So I'm right in Old Olive Branch. So I think that's all of them that are in there.
So you guys, hopefully you took down her website address, and you can reach out to her directly there as well.
And
if you
give I can give you my cell phone number as well. That's what I put out there. I can kind of say it if you guys want to write it down. The 901-734-8080. Here, I can drop it in the chat too.
I got it. I put it in there.
Okay. I'm gonna say. So you can call or text me there. I gave you my websites, homeloansbybecca.com. And then my email is becca@homeloansbybecca.com. So you can reach me anywhere if you guys have any other questions.
If you heard something that you benefited from, or if the information was good, give her a thumbs up in the chat. Awesome. Thank you, Whitney. All right, Jasmine.
Okay.
Awesome.
Well, thank you everyone for hanging out with me tonight. I appreciated it. Thanks for Denise for putting this together for us.
Yes. Awesome. Being educated is what I lack, so this is very helpful. Wonderful. It was some good.
Perfect.
She shared some really good information. Awesome.
I love it. Yeah, I love it. I love doing these classes and just kind of helping people. So it's always enjoyable.
Wonderful. All right, you guys. Well, I hope that you reach out to Becca to understand what your situation is. That's the biggest thing that I took from it. If you have a desire in your heart, don't know when it's going to take place, but you have a desire in your heart, find out what you need to do so that you can take advantage of the time, to get yourself ready. So when you are actually ready, mentally ready, that you have everything in place to do it as well. So I appreciate you, Becca, for sharing with our community. And if you are not a part of the Decide Tribe, please join our Facebook group as well. You're now on my distribution, but we would love for you to be able to participate next week. If you know anybody that either recently had someone graduate from high school, or even their student is going to be a junior. I'll be interviewing my daughter who just graduated from college to share how she, some tips that she thinks is important to prepare your students to get to and through college successfully. So that's what we're going to do on next week. So thank you guys. You guys have a great rest of the evening, and hope to see you guys soon. Have a good one.
Right.
Thank you, Becca.
Thanks, everyone. You're welcome. Thank you. All right. Bye.
Bye.